You see them every single day, usually without even meaning to. You glance at your phone, or a news channel is on in the background, and a little row of numbers slides past. The Dow is up. The S&P is down. The Nasdaq did something in between. 3 names, 3 numbers, said with total confidence, by people who assume you already know what they mean. But quietly you might not. What is the Dow, actually? What is the S&P 500? What is the Nasdaq when it shows up as a number instead of a place? You have heard these words 1,000 times and nodded 1,000 times, and nobody ever stopped to explain them. That is what the next few minutes are for. By the end, that little row of numbers will stop being background noise and start being something you can read. Not memorized. Understood. So the news finally talks to you instead of past you. Let's start by clearing up the single biggest confusion. Last time, we talked about the exchanges. The New York Stock Exchange and the Nasdaq. Those are the places where stocks are actually bought and sold. Think of them as enormous stadiums where the games happen. Big, loud places where the actual buying and selling plays out, company against company, every single day. But the Dow, the S&P, and the Nasdaq index are not stadiums. They're the scoreboard. Hold on to that picture because it changes everything. A scoreboard does not play the game. It does not hold the players. It simply watches what is happening and turns it into a single number you can glance at and instantly understand. That is all an index is. It is a scoreboard for a chosen group of companies. Somebody picks the group, agrees on how to count it, and the result is one tidy number that stands in for all of them. You cannot walk into a scoreboard. You cannot store your shares inside it. An index does not own anything. It just measures. It takes a basket of companies, tracks what they are worth, and boils all of it down to one moving number. One number doing the work of hundreds. When that number goes up, the companies in the basket, on average, went up. When it falls, they fell. That is the whole trick. So really, there is not one scoreboard. There are several, each watching a different group of players. Let's meet the 3 you keep hearing about, because each one tells you something different. We will start with the oldest and most famous, the Dow Jones Industrial Average. This is the grandparent of them all. It was created all the way back in 1896 by a man named Charles Dow and his partner Edward Jones. If those names sound familiar, there's a reason. The same 2 men went on to found the Wall Street Journal. They wanted a simple way to take the temperature of American business in one quick number. Before their number existed, there was no easy way to say how did the market do today at all. When it began, the Dow tracked just 12 companies. Big, heavy, industrial names of the era. Coal, sugar, leather, gas. The kind of businesses that built the country before screens and software existed. One of those original 12, General Electric, was a name people would recognize for the next 100 years. Over the decades, the list grew and modernized. And for a long time now, it has held exactly 30 companies. 30 of the most famous names in the country, standing in for the whole economy. But the Dow has a quirk, and it is an important one. The Dow is what is called price-weighted. That is a strange phrase. So let's make it plain. The Dow cares about the share price of each company, not about how big the company truly is. Here is why that is odd. Imagine one company with a very high share price, but a medium-sized business. And imagine another company that is genuinely enormous, one of the largest on earth, but happens to have a low share price. In the Dow, the one with the higher share price pushes the number around more, even if it is the smaller business. The scoreboard is being swayed by price, not by real size. A $50 move in one share can outweigh a far more important shift in a much larger company, simply because of the sticker on a share. It is a little like ranking athletes by their jersey numbers instead of their actual stats. That is why, even though the Dow is the name your grandparents knew, professionals tend to treat it as more of a historic headline than a true measurement. It is famous. It is just not the most accurate mirror of the market. So if the Dow is not the real benchmark, what is? That brings us to the scoreboard the professionals actually watch. The S&P 500. The S&P 500 was introduced in 1957 by a company called Standard & Poor's. And the idea was more ambitious than the Dow. Instead of 30 famous names, this scoreboard would track 500 of the largest companies in the United States. 500, stretching across technology, banking, healthcare, energy, retail, almost every corner of the economy at once. It is a far wider, far deeper picture than 30 industrial giants. If the Dow is a quick snapshot of a few famous faces, the S&P 500 is closer to a full team photo of corporate America. And it fixed the Dow's quirk. The S&P 500 is market cap weighted. That phrase just means it weighs each company by its true size, by what the whole business is actually worth, not by its share price. So the giant companies count like giants, and the smaller ones count like smaller ones. The scoreboard finally reflects reality. Here is the number that tells you why this one matters most. The 500 companies inside the S&P add up to roughly 80% of the entire value of the United States stock market. 80% in a single figure. So when a reporter says the market had a good day or a bad day, this is almost always the scoreboard they are reading from. When people say the market, they usually mean this. It is the quiet default behind the word, even when no one says its name. Now for the third name in that little row. The Nasdaq, the index, not the exchange. Remember from last time that the Nasdaq exchange was the digital one, the home that technology companies flock to. Well, the Nasdaq index simply keeps score of the companies that trade there. And because so many of them are technology companies, this scoreboard leans hard into tech. That makes the Nasdaq index the one to watch when you want to feel the mood of the technology world. When software and chips and the big internet names are soaring, this number leaps. When tech stumbles, this is where you see the bruise first. It is the scoreboard of innovation, and it swings harder than the others because of it. If you want to know how the future is feeling on any given day, this is the number you check. So now look back at that row of numbers with new eyes. The Dow, 30 famous names, weighted oddly by price, the historic headline. The S&P 500, the real benchmark, 500 companies, about 80% of the whole market. The Nasdaq, the tech-heavy scoreboard, the pulse of innovation. 3 scoreboards, each watching a different slice of the same game. And here is why any of this should matter to you, beyond just understanding the news. A single index number quietly summarizes the fate of hundreds, sometimes thousands, of real businesses at once. It is the closest thing we have to asking, is the economy okay today, and getting an honest one-word answer. That is a quietly powerful thing to be able to read for yourself. But there is one more idea, and it is the one that genuinely changed how ordinary people invest. For most of history, you could read the scoreboard, but you could not own it. You could only buy individual companies one at a time and hope you picked well. And picking well consistently year after year is brutally hard, even for the professionals who do it for a living. Then a man named John Bogle had a quietly radical thought. If the S&P 500 already represents most of the market, why not let a regular person own a tiny piece of all 500 companies at once? Not pick winners. Just own the entire scoreboard. In 1976, Bogle launched the first index fund for everyday investors. It simply tried to match an index rather than beat it. You hand over your money, and instead of betting on one company, you own a sliver of the whole basket. The strategy that had belonged only to big institutions was suddenly open to anyone. A teacher, a nurse, a teenager with a first paycheck, all of them could now own a piece of the whole market with a single decision. It is hard to overstate how much that one idea reshaped investing. It meant you no longer had to be a stock-picking genius to participate. You could quietly own a piece of the entire market, the whole scoreboard, and simply rise and fall with it over time. No predictions, no genius required, just patient ownership of the whole game. Nothing here is financial advice, and no number on a scoreboard is ever a promise. Indexes fall as well as rise, and owning the market means owning its bad days too. But understanding what these numbers are is the foundation underneath every smart decision that comes later. So let's go back to where we started. That little row of numbers sliding across your screen. The Dow, the S&P, the Nasdaq. You used to let them blur past 3 confident words that belong to other people. But now you know exactly what they are. They're scoreboards. Each one is quietly keeping the score of a different group of companies, telling you, in a single glance, how the game is going. In the next episode, we take the obvious next step. If you can own an entire scoreboard, can you actually make money doing it? And if so, what does it really take, and what does it quietly cost you along the way? Stay with me. I'll see you in the next one.